All right, welcome to the Monday edition of the On the Tape podcast, joined today by Guy Adami and Liz Young-Thomas. Welcome, people.
Good morning.
What up, peeps?
All right, we got a big week. Before we look forward, I want to look back a little bit, but some of the things going on this morning, yields rising, something that Guy has thought would happen. Oil continues to move higher. We have some earnings. We have an AI event. We also have a few downgrades this morning to talk about in some big tech names. But let's start with Friday. Liz, love to get your take on the jobs report. Some folks kind of poo-pooing it a little bit despite some of the revisions higher in some of the prior months. Big beat, though, for September. There's some things in there, maybe seasonal. I know our main man, David Rosenberg of Rosenberg Research, was talking about some of that. What was your take on the jobs number? And then we'll focus on what happened in the markets, because it was pretty much an orgy of buying for most of Friday.
It was. And you know what? For somebody who's been pretty conservative, I'm speaking for myself here, pretty conservative and worried about some of the risks out there, it is really hard to look at that jobs report on Friday and say that it was a bad thing. So we beat on payrolls, meaning more jobs were added than expected. The unemployment rate ticked down to 4.1%. Now, do I believe it's the beginning of a trend, more downward? Not necessarily, but it is difficult to look at that data and say, oh, something's wrong here. So it was still strong. The economy, at least as far as the labor market is concerned, appears very strong still, or at least stable. Now, some of the poo-pooing that I've heard, which I do buy into, is that if the Fed cut 50 basis points in September, and now we've got a more strengthening labor market, maybe the risk of inflation reheating is higher than we originally thought. We won't get as many cuts as we thought, and they'll have to wait longer. That, I think, is probably more likely now. I still maintain I don't think that we're in a place in the economy where consumers are going to start spending as much as they did before to a point where demand will outstrip supply. Where I still think the risk remains is in the commodity complex, and we're already seeing that in oil prices, and that inflation would reignite because of commodity prices. But as for Friday's jobs report, difficult, like literally would have to twist yourself around into a pretzel to try to say that that was a weak report.
You'd have to be like Serena Williams' nephew or cousin from the University of Alabama, who at like 17 years old or whatever. I mean, that kid is a freak. You talk about twisting yourself in a pretzel. Look at the last 2 weeks and what he's done. Although, Dan, as you know, the University of Alabama fell to Vanderbilt. First time that's happened in quite some time. But Liz is right. I mean, there was a lot to like about that. Rosie pointed out some of the flaws, but caught me by surprise. But then it goes to, what does it mean for rates? And you sort of tease that few minutes ago. Liz texted me before this show and said, look at the yield curve. It's flat again. And that's amazing. And it's happened with 2-year yields basically going back to 4% in a straight line in a way that, it probably hasn't moved to the upside, at least in quite some time. You obviously saw it to the downside, but here we are now reversing, and 10-year yields sort of either side of 4%. I don't know what it means. I think the optimist will say, well, yields are going higher for the reasons Liz just said, because the economy's on sort of terra firma and things are going well. But, the pessimist will say, what's going on here? You obviously have a lot of government funding that needs to be done over the next couple of years. Maybe people are not going to be in a hurry to buy our debt at the yields that they're currently trading at. So I think there's something here for everybody, but I think it's really important to focus on yields and to talk about it quickly. And to Liz's point, it's a commodity reacceleration predicated on probably what's going on with China over the last couple of weeks that should actually give people some pause.
Yeah, it's interesting. If you look at gas at the pump, okay, per gallon, I think it's about 320. Maybe it's gotten up to 325 with this move of almost, I don't know, at least 10% just in the last week and a half or so. I think the high average over the last year has been above $4 or so. So it'll be interesting to see if this move in commodities is transitory. Obviously, geopolitical events is kind of weighing top of mind. But to your point, Guy, about China, the stimulus, what does that do? The other thing that's interesting on the labor front, though, we have seen wages go higher, right? And so again, they were not keeping pace with inflation over the last few years, but we've seen that spike. So at the end of the day, it'll be really interesting to see what forward inflation expectations are, because again, workers are making as much as they have probably in decades, probably relative to inflation too, but you still have a very negative view of the economy. So it'll be interesting to see how that shakes out. A lot of folks feel really good about that soft landing narrative, and then some are speaking about a no landing, Liz. And so again, if you are skeptical of some of this data, you are worried about inflation reigniting, especially at a time where the economy's humming along, but we just had this big rate cut or so. How does that make you feel about the economy at a time where a lot of market strategists are raising their targets to 6,000 or higher, and we have an S&P that's up 20% on the year, which is pricing in at least a soft landing right now?
I think it's fully pricing in a soft landing, and it's pricing in the idea that the Fed is going to slowly lower rates down to neutral, maybe even that it's going to take until 2027 to do so. It is very rare. I'm not sure it's ever happened that the Fed has gone that slow to bring rates back down to neutral. So the risk that remains now is that if data continues to be hotter than even the Fed expects, they have to keep rates higher than we expected, which could again run the risk of them keeping the discount rate too high for too long, which eventually causes a recession anyway. So this idea of soft landing, no landing, hard landing, the no landing narrative, I think, first of all, there are many different definitions for no landing. I believe what is being proposed right now as no landing is basically we completely avert recession. We do like a maverick flyby, right? We fly by the tower. We go from sort of mid to late cycle back into early cycle, and we start it all over again. And that's the proposition for a no landing scenario. I suppose it's possible. I still think that there has to be some sort of at least landing in general. And what I believe is happening, especially in the labor market, is that although you have people who are employed and wage growth has been decent, but to your point, not kept up with all of the really non-negotiable items in inflation, it's been decent. But what people are now feeling is that hiring has slowed down, quits rates have slowed down. So basically, there's not a lot of margin for error. There's not a lot of room for mistakes in economic data. I think there's more room for mistakes in the market because the market is so high that little pullbacks are not going to be that detrimental to people's portfolios, but there's not room in economic data. So any little uptick in layoffs, and there aren't as many companies hiring, so those people who get laid off won't get picked back up again. And because the quits rate is down, people aren't leaving jobs. There just aren't as many open positions to go around. So I think that's where some of the more negative economic sentiment is coming from.
All right, guys, she buzzed the tower a little bit on that one. Maybe that's a little bit of a preview of what she might be writing about in her blog
I
on
like when we give her ideas.
SoFi.com.
We like to be the
I
inspiration
like,
for
I like that
UIT
too.
from time
I
to
wasn't
time.
planning on it, but now I am.
Buzzing the tower with Jerome Powell. But listen, I think it is fascinating. The optimist will say the Federal Reserve has done everything right. I know Larry Summers made a comment, I think last week, about 50 basis points being a mistake. We'll see. That reacceleration of commodities should be concerning. But I'll say this, and I don't know. I mean, maybe Elizabeth knows, and I'm not looking to put her on the spot. But if we were to sort of go from the inversion at historic levels in terms of duration back to a steepening and then back to an inversion, I mean, I don't know if historically we've seen anything like this. And if this 2-year yield continues to the upside, I wish I knew what it meant, Dan, because I don't think we've seen it before, Liz.
Yeah, well, if you look at a longer term chart, I was doing this last night, a longer term chart of the spread between the 2s and the 10s, we've seen over the last 6 months or so these attempts at going higher, meaning the attempts at re-steepening. So we get really close and then we sort of give some back and we go back further into inversion, and then we go up and make new highs in the inversion. So I think that's probably what's going to happen this time too. We've given some of it back. We're narrowly at about 0 as an inversion right now. I think we probably stay uninverted, but there might be some little fits and starts in there. The other thing I would say is, back to the Top Gun thing. All right, so he does his flyby, but eventually he gets in a lot of trouble for that. He gets what's called on the carpet. That's an Army term. And he gets yelled at. So eventually there are consequences to pay for that. And I think it will happen the same way in the economy. If we have a no landing scenario, there will be consequences somewhere. I don't know where. It may only be in a certain sector of the economy, but I don't think we get away with it completely unharmed.
Yeah, so let's talk about the consequences in the stock market here. If we just look back on Friday, banks were just a massive outperformer. If you think about that, JP Morgan was up nearly 3%. Some of the other money center banks were up more than that. And, I also look around. I see what happened to the airlines. I see what happened in industrials. I see what happened in big tech. And, if you look at just the things that were underperforming, as you would expect, anything related to housing and the IYR, and then obviously XLU was down a little bit. Guy, were you surprised how quickly investors were to come back to stocks, given the fact that, strong economic data, strong economy, which also means that rate cuts, as Liz just said, are not likely to go at the pace which a lot of optimistic investors were kind of taking it, especially the day after that rate cut. Do you remember just what happened there? It was just an explosion of buying. So we had an explosion of buying the day after we saw rate cuts, and then the day of a strong jobs report, we saw, just
Yeah,
stocks go
the
parabolic.
knee-jerk reaction in banks was, well, yes, it was surprising because I didn't think it was going to happen. I thought the last couple of weeks the trajectory was sort of lower. If you look at a JP Morgan, for example, which I think made its all-time high around right at the end of August, beginning of September. I thought the trajectory then would be to take it through the lows maybe we saw on August 5th or so. Obviously now that's sort of reversed itself. So it took me by surprise, but I'm trying to figure out what people are looking at. Maybe they see sort of this economy that they believe to be on strong footing and then sort of turning back to the upside, and that theoretically that should be a supportive environment for banks. And I think that was sort of the knee-jerk reaction. We'll see, by the way, what they have to say, because we hear from JP Morgan, believe it or not, this Friday, the 11th of October, which is amazing. It feels like we just heard from the banks, yet here we are again. So it's going to be, to me, it's going to be interesting to hear, obviously, the quarter, but more importantly, I think the commentary, specifically from Jamie Dimon, because I think some of the other banks tend to be a bit Pollyannish for me.
Well, so here's the thing. One of the linkages that I've been making from the stock market to the bond market is what is happening in the yield curve and why. And we've talked about bull steepening for a long time, and that's what brought us out of inversion. But now with this flattener, and we've got the 10-year yield rising, the 2-year yield rising, I think what happened last week and what may continue to happen this week, perhaps until CPI, which we can't forget to talk about that a little bit. But what happened last week was just the resurgence of a cyclical trade. Basically, the economy is strong. We will continue growing. Everything is stable. And banks took part in that. So I don't think it had anything to do with what we call the NIM, the net interest margin. But I think it had a lot to do with the cyclicality trade. And what that means for banks is that then what they have lent out to consumers, maybe the default rates will be lower. People are employed. They'll continue borrowing money. And we have to remember that in a healthy economy, borrowing money is actually a good thing. It sends more money around and around and around, and there's more for people to spend. So I think that was the reaction last week in banks. But obviously, we know earnings season starts this week and they set the tone. The other thing is when you look at the top 3 sectors in the trailing 1 week, we've got energy far and away at the top. I think we know why that is, because oil prices have risen and margins will go up in a commensurate way. And then communication services, financials was number 3. Utes is still up there in the 4 spot. So we have to not forget about that. And don't forget about gold either. There are messages coming through from the market that the market isn't entirely sure and hasn't entirely bought this yet. But something that did change a lot on Friday was we erased an entire rate cut from expectation. So we're back down to 2 rate cuts. And I think that continues to buoy stocks unless we get bad news.
By the way, Guy never forgets about golds, but we'll talk about that in a second a little bit. Let's go to some single stock names. I think it's interesting. We walk in this Monday morning, so we're shortly after the open as we record this. A couple downgrades and a couple big names. Amazon over at Wells from a buy to hold. Apple also to a hold from a buy. I want to hit Amazon, Guy, quickly here. It's down 3%, which is kind of surprising. The analyst takes the stock target from 225 to 183. The stock is trading right now at 181, which I think is really interesting. Rarely do you see that with a downgrade. You'll see a 225 go to 200 or something, that leaving a 10% upside for 12 months. They're talking about competition with Walmart. They're talking about this was a revision story over the last year, and therefore some of the revision potential is abating. A lot of that has to do with some of that advertising revenue that was very high margin. Thoughts there? You've talked a lot about Walmart and their ability to take share from a whole host of different retailers, but that's a surprising downgrade, and I'm surprised that the stock's down.
Well, I mean,
3%
I
also.
admire it. I mean, basically, if you read the note, which you obviously have, no upside and short-term pressure on the stocks, and that obviously is as we get in the earnings period. And, Amazon's one of those funny companies when, things are going well, nobody cares about valuation. When things in terms of the stock are going poorly, everybody focuses on it. And, I look at it and say, okay, we made the all-time high in July, like, many stocks did. We've pulled back a little bit. What is the setup into earnings? Is it a good setup or a bad setup? Quite frankly, if we were to get back down to the August low into that earnings release, it probably sets up pretty well. But right here, I look at it and I look at what's going on in the market. I say we're a bit of a no man's land here. I mean, valuation is always a concern. They seemingly can sort of flip the switch in terms of margins whenever they want. And it comes down to what type of quarter they're looking to report. But I think the competition aspect, which historically has never been a problem for Amazon, I think is becoming more so, especially given what Walmart's been able to do.
Yeah, and let's look at Apple. So Jefferies downgrades that stock from a buy to hold. Interesting on stuff that we've been talking about, Guy, for a while here. Optimism about the iPhone 16 upgrade is probably a bit unwarranted. That stock's down less than 1%. I think there's some sort of note out suggesting that Apple Intelligence is going to ship with iOS 18. When I say ship, that will be an over-the-air software upgrade on October 28th. So it'll be interesting to see what is actually in Apple Intelligence. I know we previewed it over the summer, at least the company did at Worldwide Developers Conference. One of the things that we thought was really disingenuous from an advertising standpoint. For 2 months, they've been suggesting that the new iPhone is Apple Intelligence. Well, it's not there. I have the 16. So let's see how it goes on the 28th. But one thing I'll just say, Guy, maybe you can comment on this. Apple has the lowest amount of buy ratings that I can remember in a very long time. 65% of analysts who cover the stock have a buy rating. And the flip side, Amazon, 94%. Okay, so when you see that sort of downgrade one versus the other, it is kind of interesting. In the Apple scenario, they downgrade, but they raise their price target. So thoughts on Apple really quickly. And Liz, we're just focusing on these two names because, again, they're huge contributors. And after this, I want to get your take on the whole broadening out narrative. But Guy,
Yeah,
Apple.
well, I mean, the Jefferies analyst said attractive long term, but they think the tech giant's hardware, now I'm quoting, needs rework before being capable of serious AI with a likely timeline of 2026 or 2027, which is something that you've been saying for a while. And that makes sense. I mean, yes, Apple is always attractive long term when you sort of look at the timeline of the company. I mean, seemingly every sell off, I know we've seen a number of them over the years, has been gobbled up, and analysts, generally speaking, are supportive. But when you look at it and think of all the optimism since that June 10th release, I mean, is that really justified? And is that justification for this valuation that we're trading at? And, we're going to find out. I've thought for a while now incorrectly that we'd see a retest of that June 10th low, which was 193 or so. And I still think there's a chance, especially if the broader market starts to roll. But, your point about analysts, the lack of optimism around the stock, I think it's front and center in terms of its valuation and in terms of probably the timeline of the AI rollout, which is a lot farther out, I think, than the market realizes.
Well, here's what I'd say about the broadening out story. So obviously we've split stocks into the Mag 7 and then the S&P 493. I just gave a presentation last week. I called it Stick the Landing. And a slide in there broke up basically what are the contributions to returns from these various stock groups compared to last year. So if we look at the Mag 7 X NVIDIA, so take NVIDIA entirely out of this equation, last year, they made up more than half of the S&P's return. Okay, so Apple obviously being in that bucket. This year, only making up a quarter of the S&P's return. So the rest of the Mag 7 not carrying their weight as much as they did last year. I think that's a good thing. We're not quite as dependent on 7 stocks as we were before. And then the S&P 493 last year made up 38% of the S&P's return. This year, making up 56% of the S&P's return. So the broadening out narrative is true. It's happening. And if you look even across a lot of different sectors and things like gold is outperforming the market for the entire year and for a trailing 1-year basis, I believe. So there's been plenty of other places to make money. It's just that our commentary and our narrative continues to focus overly on these 7 stocks, but there are other opportunities out there. What we need to happen, and I will say this until my face turns blue, in order to confirm that this rally is in fact due to cyclicality and we can get back into earlier mid-cycle, we need small caps to come in. We need them to make new highs and we need them to stay up there. That still has not occurred.
No, it has not. And before we get on to sort of energy, which I quickly want to talk about, Elizabeth, my sense is at one point you were a gymnast and you'd be very difficult on yourself if you didn't stick the landing. You'd be like, shit, I'm going to try that again. Is that accurate?
I did do some
Yeah,
gymnastics when I was younger, yes, and then my cheerleading squad was very much into
of course
gymnastics.
they
It
were.
wasn't so much the cheering, it was a lot more of the competing. So, and yes, I am constantly hard on myself about sticking the landings in all respects.
Yeah. Anyway, sorry,
Yeah.
Dan.
So we're trying to figure out whether, this move in the market has been cyclical or secular, and you just broke down the data, the Mag 10 versus, let's say, the other 490. It's interesting that these narratives are still moving the stock market this week on Thursday. That would be October 10th. Two kind of big events, in my opinion. AMD is hosting Advancing AI 2024. There's some analysts out there suggesting this could be a catalyst. The stock has rallied 40% off those August lows. The company's going to showcase some new AI servers and the like. I know that a lot of, kind of investors got excited about this stock playing some catch up last spring, had that huge rally. I think it doubled in a matter of months, and then has kind of, before this rally over the last 2 months, it gave everything back here. So, Guy, thoughts on this as a catalyst? NVIDIA, has worked its way back. It's kind of broken out from a downtrend that's been in place from late June, but this is really about AMD playing catch up. I know investors are dying for another, kind of name in the space, at least in the chip side, to play other than Taiwan Semi that makes most of the chips and NVIDIA that has most of the market share in the high end. So thoughts on AMD actually taking over the baton a little bit and being a name that folks
Well,
can
that
get
was
behind.
obviously the hope into the spring of this year when AMD traded up remarkably to about 200 and I think $25 or so before you had that pretty precipitous decline. I think people want there to be a company they could wrap their head around in terms of valuation. Of course, the problem is, AMD has historically gotten itself pretty expensive on some of these moves to the upside. I do think there's a chance that the market moves towards AMD once again, but the fits and starts in this stock have been remarkable. And you just go back to July. I mean, this was a $185 stock. We traded down to, I think, Dan, about 125 or so. Subsequent bounce, traded back down to those levels. So, here we are at 170. I think the likely scenario here is we sort of do this levitation into this event, maybe back to 180. But I do think the market is, in my opinion, setting themselves up for a little bit of a disappointment here. So we'll see how it plays out. But yeah, you're right to point out AMD and some of the narrative around that company right now.
Yeah, and just to be really clear, the options market is expecting nearly a 6% move in either direction between now and Friday's close in AMD. That's pretty surprising. You talk about the potential for a disappointment. The other really, what I would say, large event is Tesla's robotaxi, event on Thursday afternoon. Also, the options market is implying, a 20% move in either direction. That's on a $246 stock. That's high single digit percentage if you can do the math there. Guy, thoughts here, because the stock has had this massive run over the last couple months. It probably doesn't set up too differently than AMD because both of these sort of products are way off in the offing, if you will. Did I use that correctly? Off in the
Yeah, it
offing. That's a lot
works.
of offs in one sentence. But again, the Tesla thing is probably years out. AMD, we're
All
talking
right.
quarters.
So let's just take a look at Tesla. I'm going to try to take my emotion out of it. Go back to December of last year. Its stock chopped out around 265 and then obviously had a huge sell-off into the spring. The subsequent rally into July got you back to what, Dan? 265. And then, like everything else, sold off into that August 5th low. And then this recent move back off the August 5th low got us up to 265. So the level of resistance is right there for everybody to see. A 20% move would be remarkable, given where the stock is. Remarkable if it were to build upon it, I guess, because 20% from here, Dan, you can do the math. That's a $50 move. So very quickly, we'd basically go from current levels to a $300 stock if, in fact, it surprises people to the upside. To me, that's the less likely outcome. The more likely outcome, I think, is to continue this trajectory that it's been on. So if you're asking me to sort of game this thing out, this 265 level-ish has been resistance a number of times. I'd be shocked if we got through it in a meaningful way to 300. Stranger things have happened. I think the more likely scenario is we sort of do the back and fill.
Yeah, it's also interesting. There was a story out this morning that Geico, the little green gecko guy, they are no longer insuring the Cybertruck from Tesla, which I do think is interesting because they're talking about the poor build and the like here. So whatever that's worth. All right, Liz, before we get to energy, I want to hit a story that was in the Wall Street Journal. Corporate insiders are sitting out the 2024 stock market rally. Guy has mentioned this on many occasions that Jamie Dimon said this maybe a month or two ago when the stock was very near its all-time highs. It might have been on the last call that they are not buying back their stock. The S&P 500 has had its best 9 months since 1997 with a 21% advance and a 43 record closes in 2024. Corporate insider buying is at a historically low level with only 21.9% of companies reporting net buying in September, below the 10-year average, Liz, of 26.3%.
So, a couple things. First of all, on the list of things to be concerned about, I'd put a lack of insider buying below something like a lot of insider selling, right? So, it would be much more concerning if we saw a lot of insider selling going on. A lack of buying, I think, is more of a pause button. The other little caveat here is Jamie Dimon, mad respect for the man, but he has been cautious. And many months ago, he even said he wouldn't buy their stock at the levels it was at from a valuation perspective. And we know that he's been a big buyer with his own money of JP Morgan stock at a lot of times throughout the last few years. So that was an important statement, but he has been cautious for a long time. Now, the lack of insider buying, I would put, and this is just my opinion, I don't have a direct line to all the CEOs to find out whether or not this is actually true, but I would just put this at a question about whether or not margins will be able to be maintained, and or the fact that we've seen a really good run in stocks, and looking at where valuations are, does it make sense to buy at these levels? Also, remember, insiders probably already hold a lot of their own stock. So if they're not adding at these levels, I'm guessing their tax lots that they already own are at much more attractive price levels. Why add at something that's this high? Now, does that send a message to markets that this is not a great entry point? Probably. Not a great entry point if you don't have positions in a lot of these stocks that have run up, but it doesn't necessarily mean that there's this impending disaster that somehow all of the CEOs know about together. I think it's more of a cautionary tale of valuations, lack of clarity on rates, and just lack of clarity on what everything is going to do to profit margins for the next 6 to 12 months.
Flip side of that coin is look at the amount of insider selling that's been going on for the last 6, 9 months, almost a year. Michael Dell just announced, I think, $1.2 billion worth of sales. Zuckerberg's been selling stock. Bezos has been selling stock. The flip side of that, or sort of tangentially to that, is the fact that Warren Buffett has amassed about $280 billion or so in cash position, cash equivalents at Berkshire Hathaway. So those things are all out there. And that's, again, those are these anecdotal things that nobody cares about until something happens, and then people will look back and say, well, it's obvious now. Look at all the insider selling and look at what Berkshire Hathaway was doing. We'll see, but it's definitely worth pointing out. And again, when you hear companies saying they're sort of on the sidelines in terms of levels to buy back their stock, I mean, I think they're trying to tell you something as well. Now, in the world of passive investing, none of this matters. The inflows are such that the market does not care. But as I pointed out a number of times, Dan, and I'll say again, when passive becomes active, it's never on the way up. So again, we'll just sort of see how this plays itself out.
Also, an interesting thing playing out here in the market. It's 10 o'clock. It's about 30 minutes or so after the open, and we have an S&P that's down 30 basis points. We have, crude oil up a couple percent. We have gold very near its all-time highs, just down just a very little bit. The dollar has quietly rallied over, the last week or so. And the VIX guy, talk to me about this. The VIX is 21 right here. Now, we know on Fridays the VIX gets marked down. We had a big rally, so that was more emphasis here. And maybe that speaks to what Liz is saying, is that, maybe some folks are kind of getting hedged up a little bit here as we kind of get to the tippy tops of this rally. We just read that this is the best first 9 months of the year since 1997. And I don't know if you remember that. Liz was still doing gymnastics in middle school back then, but that was a very volatile period. People forget 1997, 1998, there were some big things going on and a lot of volatility. Talk to me about golden highs and a VIX at 21 with an
well, let's
S&P
talk the
high.
VIX first. And, this is something we've thought for a while. And, we had Katie Stockton on Fast Money. I want to say late summer, but she thought there was going to be a move in the VIX, and I agreed with her. And obviously, you saw what happened into August 5th when the VIX spiked to, I think, north of 60, 65. Now, I didn't think it was going that high. I don't think she did either, but there you go. The subsequent sell-off surprised me, but I've thought for a while, Dan, that there's going to be a second round of this volatility index, and maybe we're in the midst of it now. It makes sense in terms of where we are. We're in October, and it makes sense in terms of where we are right before earnings. And you throw in all the geopolitical stuff that's been going on, and by the way, you throw in an election, which is basically 1 month away. I think it makes sense that maybe people are sort of hedging, and you're seeing it manifest in the VIX. So that absolutely makes sense to me, and I don't think that's going to change anytime soon. In terms of gold, I don't know what to say other than the fact that, we're in the environment that lends itself to everything about gold right now. And I think the sort of the cherry on top was what we heard from China last week, who are clearly making panic moves, not necessarily to protect their economy, although that's what they will say. To me, it's more about their markets and trying to sort of stem the tide there. And I think all of that sort of lines up to the favor of gold, and we're seeing it play out right before our eyes.
You know what's interesting about the gold trade, though, and I heard this from Chris Verone last week, is that retail investors haven't gotten in on it yet. So we should watch that. It's happened mostly on the institutional side. It's happened on other central banks buying gold. And usually that's what's referred to as the smart money. Not that retail investors are the dumb money, but the timing ends up being different. So something to watch is if we do start getting indications that retail is buying gold hand over fist, and the ways they would do that would be in the GLD ETF, things like that, that are available to the retail masses. That's where you start to question, are we getting toppy in gold? Hasn't happened yet, which tells me we have more room to move up.
Yeah, it's interesting. And just when we talk about behavior, the fact that retail has not gotten in yet, I'm sure there's plenty of data that highlights that. Look at the move that we've seen. US retail, you could say, okay, they can't buy local in Hong Kong or Shanghai, but you can look at the FXI, you can look at the KWEB. I mean, folks are just piling into this stuff. When you see that sort of move, 50% in literally a matter of, weeks or a month or so and a half, you just got to say to yourself, there's some folks that are going to get really poorly burned or badly burned if you think about it. And again, maybe the VIX is telling you that. Maybe, earnings season that we're going to get into. And Guy just mentioned that we're going to have JP Morgan and BlackRock at the end of the week. We have Delta and Domino's, I think, on Thursday. PepsiCo. Pepsi's always interesting, Guy, as it kicks off the week because, kicks off earnings season because we're going to hear, what their margin is, their ability to pass through some of these increased costs. It's obviously an important consumer staple if you look across their products and the like here. So anything from earnings this week other than banks?
I'm glad you brought up these Chinese stocks, and I'm going to quote Pete Townsend here for you fans. And Elizabeth, I know you're a huge fan, but no one respects the flame quite like the fool who's badly burned. From all this, you'd imagine that there must be something learned. And to Dan's point, when you haven't been burned by these things, it's sort of a willy-nilly type of thing. But when you've sort of experienced the pain of the burn, you sort of walk with some trepidation. And I'll say this about Alibaba, for example. I mean, you talked about a 50% move. Well, that's basically what you've got, a little bit more since the lows we saw in July. And we have talked about Alibaba on this show, on Fast Money, on Market Call, and on the tape dozens, if not more times. And we've pointed out that since this time in 2020, a stock that made an all-time high, I want to say north of $310, it's been an awful stock. Yet with that said, at least 7, 8, maybe 9 times now, you've seen moves off of lows anywhere from 35 to 60%. And we're in the midst of one now. So I agree with you that I think people don't know what's coming in terms of the snapback, but I do think we're probably closer than people realize, number one. And in terms of some of the earnings going forward and what we're looking at this week, I do think it's important, not in terms of necessarily the quarter, I think, but in terms of just sort of the commentary around it. That typically is the case. But I think the market is pricing in, I want to say what, Dan, about 14% or so earnings growth for next year. I still think, even with some of the revisions we've seen in terms of GDP, that's a bit excessive in this environment.
Yeah, Liz, do you worry a little bit about optimism heading into Q3 earnings and what Q4 guidance might look like here? Again, given some of the uncertainty, that's something where you could see CEOs or the C-level suite in generally being like, let's say, cautiously optimistic as we head into Q4. There's no shortage of sort of potential hiccups, starting with the election in early November, focusing a little bit on the pace of rate cuts. We just talked about how the CME Fed Fund tool is kind of losing some of the excitement about a big November cut, and then we have a potential for a government shutdown in late December, and then the longshoreman strike has been the can is been cooked out to January. So there's no shortage of potential headwinds for the economy. So if I was a CEO of a company where my stock is outperformed or maybe even in line with the 21% gain in the S&P 500, I might give some cautiously optimistic guidance for Q4.
Yeah, well, I feel like I've been saying for so many quarters now that we're too optimistic on earnings, and it's been wrong every time. So I'm gonna slow down on pounding the table on that right now. But I do think that CEOs have done a decent job. CEOs and CFOs have done a decent job about being conservative and trying to manage expectations. It just hasn't really worked. The expectations in markets have been so high, and then as we've seen over the last few quarters, especially, and this continues to get harder and harder of a bar to jump over, investors want to be blown away by results. And if they don't get blown away, they punish the stock. So the market's expectations of earnings continue to be really high, regardless of how much caution CEOs seem to try to message to them. So I think that is something to pay attention to. I'd be remiss if we were doing this on a Monday and I didn't mention that we have a CPI report on Thursday and a PPI report on Friday. Now, we know that the market has focused a lot more on jobs than CPI and PPI, but if you get some conflicting data this week, so if you get a CPI print that's much weaker than expected, which immediately follows a jobs print that was much stronger than expected, I think that's going to send the VIX higher. It's going to confuse Treasury yields, and it could also cause a pullback in equity markets.
Guy, thoughts there? Because again, yeah, we did not mention CPI, obviously a bit more important than PPI. We did have the Fed's most favorite inflation reading recently. I mean, I suspect that the CPI and PPI are going to be very benign. I don't think that they're going to be big market movers. I just, again, especially after we saw that jobs data. But you can make the argument that, okay, with higher wages, lower than expected unemployment, that maybe that pushes forward a little bit of the CPI. But the only thing that does is means higher for longer, even after
yeah,
that
higher
rate
for
cut.
longer in terms of maybe what the market is saying, but is it going to change necessarily some of the narrative around the Fed? And I think, people might look, if CPI were to come in a tad hotter, market participants might say, what, it makes sense given the recent move we've seen in some of the underlying commodities. And obviously wages maybe starting to turn up again is an encouraging thing. And there'll be some that say that's actually a good sign for the economy and then subsequently the market. So what I've learned over the last couple of years in terms of these numbers, the optimist sees what he or she wants to see, and the same thing for the pessimist, and the optimists are winning right now. We'll see how it plays out this week. I do think, I've been incorrect in this one. I do think inflation can continue to be a problem on the commodity front, specifically to Liz's point earlier, but we'll see if the market shares that concern, Dan.
All right, very last thing. One of the more interesting articles I saw over the weekend was in the Wall Street Journal, and the assumption is that if former President Trump were to win in November, the headline was "Big Oil Urges Trump Not to Gut Biden's Climate Law." I thought that was interesting. I think there was a situation a couple months ago where Trump met with a bunch of the big oil CEOs and really encouraging them to back his campaign, and he was going to be very, he was going to be pretty nice, I guess, if you will, to some of the big oil companies. Major oil companies like Exxon, Phillips 66, and Occidental are advocating to preserve parts of Inflation Reduction Act that benefit their low carbon investments despite initial optimism. Despite initial opposition to the law, these companies are communicating with the Trump campaign and GOP allies, emphasizing the importance of the IRA tax credits for their investments in renewable fuel.
If you listen to some of the things we've said, and I'll say it again, as counterintuitive as it may sound, the best thing that's happened to these energy companies has been the Biden administration. Not that they set out for that, by the way. I think quite the opposite was the case, but somewhat counterintuitively, that's exactly what's happened in terms of their, their ability to run their companies and forcing them to do things that historically they haven't had to do. So that headline, to me, I found myself shaking my head because it sort of reinforces and galvanizes some of the things that I've thought for a while.
All right, big week here. Thanks for running it down with us. I think we could probably all agree that CPI print is going to be one of the more important things. It will also be interesting to hear directionally about Q4 guidance from some of these early companies reporting in the S&P 500. Liz Young, Thomas, thanks so much for being here. Guy, Adami, you guys are going to be back together on
There
Wednesday
we
on the
are.
market call. I'm going to be out Tuesday and Wednesday. I'm sure our viewers, our listeners are going to be all busted up
What does that
about
mean,
that, but I'll be
busted up?
back on Thursday.
Right.
I don't know. They're going to miss me. And I was
Oh.
being facetious. I was being sarcastic. This Monday OTT was probably enough for you guys for a few days, but thanks so much. We'll see you guys back here, market call tomorrow and on the tape Friday.